Yeah, so today we will look more in depth to the financing parts of the corporate finance in general. So where the firm gets money, what consideration we should take into the account when dealing with the profit and when seeking for the financing. We will talk today about uh, first payout decision. So the decision whether we should pay the dividends or not, and then we will talk about financing structure decision, whether we should borrow or shouldn't borrow. There are different perspectives on those two issues that corporation faces, and we will briefly discuss those perspectives with different examples, so you will know what you should take into account when making those decisions. So first, we should think about how the firm can share its income with the shareholders. There are two basic ways firms can share this, and there is one implicit way firms does it. The basic ways how firm can pay or finance their shareholders, how firm can share its earning with them. The firm can pay dividend. So dividend is a direct payment to the shareholders. In a couple of slides, I will explain you how it is organized. Alternatively, what firm can also do, firm can use its earnings to repurchase the shares from the open market. So it repurchases the shares, there will be less shares available on the market, so the remaining shares will increase in price, and that's alternative to the dividend way how firms can share its income to the shareholders. And the implicit one is just not to pay the dividends, so to reinvest money somewhere, and if they are reinvested successfully, if the firm does fine, it will continue growing in price, and investors will have their earnings as capital gains. In terms of there is a historical statistics on the fraction of dividends and stock repurchases as vehicles for transferring income from the corporation to the shareholders. You see that 20, 30 years ago, mostly 30 years ago, that repurchases were not very common, but later on they became more and more popular, and these days they are more or less equal. So the fraction of stock repurchases and the fraction of dividends as a way to share the income with the shareholders. So here are some some definitions of the terms that we just discussed. That stock dividend, the formal definition is the distribution of additional shares to firm stockholders. Stock splits is the issue of additional shares to the stockholders. We discussed it some time ago, and maybe you came across this working on the first homework, that sometimes when the stock price goes up, in order to keep it liquid, the firm might decide to make a stock split. So instead of one stock for each single stock, they might convert them to the 2 or 3 or more stocks. The point here is that it happens, for example, it happened to Tesla recently. So the first initial price was quite low, but then the price reached 1,000 or even more, and the more expensive each stock, the less liquid it becomes. So less investors can afford it, and it affects the trading volume of the stocks. In order to support this trading volume, firm might decide to make a stock split, so the price at each stocks will get lower, and there will be more investors who can invest and sell them, and therefore the trading volume will be better. That will support stock price. And dividend as a payment to the shareholders, they might be either regular or special. The regular are those which are paid after announcing of the results. So from each quarter or yearly, firm publishes its results and announce what would be the amount of dividend. It is a regular. And the special dividend, they take place, then there is some special occasion. For example, if the firm sells some unit within it and has additional cash surplus, and if investors decide that the firm has to pay those money out to its owners, then there will be the special dividend. So it is not regular sharing of the income with the shareholders, but it is a sharing of some special income that is not regular. For example, selling some unit or having extraordinary profit, which is unlikely to remain. And in that case, we will talk about the special dividend. How the payment of the dividend is organized. There are multiple steps in this process that we should understand in order to be able to work with it. So the first is the declaration date. Then it usually goes together with the announcement of the results for the quarter or for the year. And the firm might, it declares the results and say that we will pay some amount of dividend per share. In this case, we talk about Pfizer that announced that it will pay 28 cents per each share as a dividend. Then the next date would be the first date at which you are not eligible to receive the dividends. So in order to receive the dividend, you have to own it till the 5th of February, till the 3rd of the February. If you purchase them on February 4th, you will not receive the dividend. That is why we need this, because the shares belong to the thousands or millions of investors, and it is not that straightforward to determine who is the owner of the shares and who is eligible for receiving the dividend. And that is why there are formal dates, months, seconds at which you have to own the share in order to be its shareholder and receive the dividend. So if you own the shares at February 5th, the last moment of trading, then you receive the dividend. If you buy it only on February the 3rd, so this would be last pre-dividend date. And ex-dividend date would be the first date at which you are not eligible to receive the dividend. And at these days, usually the stock price goes down at the amount of dividend. So it makes sense. So if you purchase them stock at the ex-dividend day, you are not eligible to receive the dividend, and that is why the stock getting cheaper. And there is a difference between this ex-dividend date and record date, and the difference would be due to the fact that stock market has to process all those transactions and process information about the current owners of the stocks, and as a result, there will be usually 2 days between ex-dividend date and record date. So the record date is the official date owners at which receive the dividend, but in order to be recorded, you have to purchase the shares before ex-dividend date, because it takes some time to formulate the register of all the shareholders. And finally, after some period, it can be months or even longer, you receive the dividends, so they will be transferred to your accounts. So there are multiple steps in payment of the dividend, and as a shareholders, you should keep them in mind. And dividends, except for the just financial support of the shareholders, they have some other functions. Important function of the dividend is information. So they send the message to the shareholders, and the message is mostly sent through the change in dividend. So managers, they avoid decreasing the dividend, because it means that the things are getting worse in the firm, and knowing that, they are less likely to increase the dividend, because once you increase the dividend, you know that you shouldn't decrease them, and that is why you think twice when you consider raising the dividend, because if the level at which you will raise them is not sustainable, you might create some troubles later on. Then firm has some extra profit, the firm can have special dividend. And this, talking about this increasing and changing in the dividend, we mostly talk about the regular dividend. And yes, they shouldn't be reduced, and that is why the managers are not very do not like to increase them without any particular reason, strong reason. So in order to increase them, they should be fairly confident in their ability to remain them on this new high level. So it is important to keep in mind that dividend, in content that dividend has, we should consider it together with all other related data concerning the firm, and depending on the situation with the firm, there might be different messages sent. So for example, in Russia, most state-owned firms, they have a restriction what fraction of the price, what fraction of the earnings they would pay out as a dividend. So as they mostly belong to the state, and state needs money, so they push them to pay higher fraction of dividend. And you can also benefit from it by purchasing the same stocks, and the major shareholders state insist on paying dividends, and you as a minor shareholder would also receive those dividends. So here is the list of factors that managers consider making the payout decision. So as a leading one was mentioned, avoidance of the reducing the dividend. And also there are multiple other factors that is considered. So it is not just the decision that firm says, look, we have some money, let's pay them out. to the shareholders. It's not that straightforward. There are multiple dimensions the firm must take into the account, so that firm shouldn't reduce the dividend, that it sends the message to the shareholder, and therefore all those factors should be taken into the account, making the payout decision. And there are different perspectives on the There are different perspectives on this decision, and there is one radical perspective of Miller and Modigliani, who said that it is irrelevant whether firm pays dividend or not pay them. So they claim that the dividend policy is basically irrelevant, and they provide some justification to their idea. So let's consider it by the example. We have a firm called Rational Semiconductor, and the firm has some surplus cash. So it earned 1 million as a surplus cash, and it decides how to use this amount. It can either pay them as a dividend, or the firm can use those money for shares repurchase. If the dividend is paid, what would happen? We'll have fixed, so we will have surplus cash goes away. Instead of 1 million, it will get to 0. Fixed assets, they remain, and the total shareholder wealth remains 11 per share. So it is $10 would be the value of the single share plus $1 received as a dividend. In this case, we consider that there is 1 million shares in total. If we talk about stock repurchase, so if we talk about this case, how it would look like. The firm might spend 1 million on stock repurchase. So instead of paying the dividend, the firm might repurchase the stocks. And if it does so, there would be, it will pay current price of 11. It will repurchase 90,909 shares, leaving the rest as a shares outstanding. And as the total number of shares goes down, the stock price remains at the same level of 11. And what effectively happens, the shareholder wealth also remains 11. And what is the conclusion here is that it is irrelevant whether firm pays money as a dividend or does stock repurchase, as the total earnings and total value of the shareholders is the same in both conditions. There are two basic perspectives on what we can do deciding on the value of the dividend. So we first one is a calculate market capitalization. So we can go from the company as a whole. This is a calculate market capitalization, or we can go from a single share and predicting what dividend to expect using probably growing perpetuity formula, or considering dividend to growth. So considering the growth of the dividend and the current value of the dividend, and then we can predict the value of the dividend in the future, and with this value we can estimate the share price. Or we can go with the estimation of the market cap and divide this estimation on the number of shares outstanding to have the estimation of the share price. So those are different perspectives, what you can do when you estimate the price of the stocks of the firm. And here is the example which is there also to support this idea of the irrelevance of whether firm pays dividend or does stock repurchase. We have some number of shares. So we have some number of shares before, and then we do what we can do. We have some earnings, and we can use those earnings and raising new shares. So we first pay dividend, and when we use those earnings to have new shares, as a result, the value of each shares is going down. So instead of this, it gets to that because we have 2 additional shares. So all stockholders, they would receive additional shares to remain their wealth, and as a result, the total value of the firm remains. So if the firm uses 1/3 of the of its earnings to do first pay dividend and then issue new stocks, then the total value remains. So it means that that those 2 tools they lead to the same results, as the total value of the firm is the same under both conditions. Alternatively, we can draw this we can demonstrate it by draw the scheme how the payment of the dividend or how the transfer of wealth is organized under different conditions. So dividend finance by stock issue, what it leads. So we have a firm that issues additional shares that goes to the new stockholders and receives the cash. And as all stockholders, the value of each of their shares goes down, they receive the cash, and also they receive the cash. No, they receive the cash as a dividend. Alternatively, what we can do, so this transfer of money, the same transfer of money, can be achieved just by the plain transactions between the current shareholders and the new shareholders. All stockholders gives some of their shares to the new one, and those pay them cash. And effectively, the outcome for these groups of the stockholders is the same in the both conditions. So this is one of the arguments for the irrelevance of the dividend theory. And there are some different perspectives of the dividend relevance. There is this Modigliani Miller that we just discussed, righties. So there are those who say that dividend can increase the value. They have their arguments as well that we're about to discuss. There are some middle, so people with a more moderate position, and there are also point that is the residual dividend policy, that the firm can mathematically estimate amount of dividend that it should pay. The problem with this perspective that we discussed so far is the taxes. The capital gains, so the way investors receive the money when we talk about stock repurchases, they receive the money as a capital gain. And the capital gains, they might be taxed different from the taxing of the dividend. And it leads to the situation then investors receive different income under different financing scheme. And this is also worth considering. In this case, we consider two firms. The first firm doesn't pay any dividend. The second firm would pay the dividend. And if the taxation rate is set so that it leads to the equality of outcomes, then it might be that the results are the same. And moreover, the argument that makes those who claim that the financing structure is irrelevant, their arguments would be that the stock price adapts to the taxation, and the taxation difference would be already included into the stock prices, and it will lead to the equality of outcomes for the different financing schemes. So we can look here at the example. We have a today stock price of the stocks. Then those stock that would pay money as a dividend, it has a slightly lower price because investors would receive money directly as a financing. And as the money are paid out, the growth of the stock price will be lower. There will be lower capital gain because the firm doesn't reinvest, so it has less sources for the growth, but the investors receive money directly and they can redistribute them. So the capital gain for the firm that pays no dividend is higher, but there is no dividend here. Pre-tax rate of return, something that we can estimate here. So we have capital gain plus dividend, which is a total income that investor receive. In this case is 12.5. In this case is 14.72. In this case, we invest 100 as today's stock price is 100. In this case, we invested 97.78 as the stock price is that low. The tax on dividend is 40%. Here we have no dividend, so we pay no taxes. Here we pay $4 as a 40% of 10. Then next is paying taxes of the capital gain. Both stocks increased in price, therefore we has to pay some tax on the capital gain everywhere. In this line, we estimate the total after-tax income. Here it is. So this is, in this case is 10, in this case is 9.78, and effectively the after-tax rate of return is equal. So the argument that so-called leftist says, argument that they make is that the stock price here, it adapts accordingly in order to make return equal for the any types of financing, whether you pay dividend or whether you pay whether you do stock repurchase. The market will adjust and the stock price will be as high to make sure that returns are getting equal. So this is the argument. But well, it is not always that works that perfect, because there are different groups of the shareholders. There are some shareholders, they want to have higher dividends. Yeah, so this means that they would that making the decision on where to invest, investors have some additional consideration. So they might have their preference towards dividend or capital gains, and this would prevent market from perfect adjustment to the difference in taxation, and as a result there might be deviation from this equilibrium model. Yeah, so also we talked about, so here we have a recall arguments against this dividend irrelevance, is that dividend, they also send the signal to the shareholders and to the all investors around, and that is why also it might be not perfectly irrelevant whether we pay dividend or do capital gains, because the signals are slightly different, and managers might consider those factors, and it is also would prevent from the setting to the perfect equilibrium, perfect equality of capital gain and dividend. And another factor, so we talked about the taxes, and initial perspective was that the stock price adjusts, but looking at this argument again, we can also think that state has its own objectives in terms of the financial markets, and they might be willing to have more dividend paid or more capital gain. It depends on the macroeconomic objectives that firm has, and through that firm, state can also change taxation of the different types of cash flows. That would also leads to reducing, to making one or another way of paying the dividends more preferable. Here I collected the data on tax rate in our country, the one we have, for the capital gain and for dividend income. For the tax residents, the interest rate is the same, the tax rate is the same. The tax resident is any person who spends there more than half of the year, and then you are considered a tax resident, and then you have to pay taxes in this country, even if you are a citizen of another one. And tax non-resident, those who might be registered abroad or spend their little time, they pay slightly higher taxes, but there are laws on double tax avoidance. So in the country where they are resident, the taxes might be even higher. They won't have to pay them twice. So it might be still good for them to be tax non-resident here and avoid paying double taxes. And what is important to consider talking about taxation of the capital gains is that those gains no, they are deferrable. You don't have to pay the taxes until you sell the stock. So you purchase some stock and it might go skyrocket. The price might go very high, but you do not have capital gain in the tax sense until you sell it and have it, your capital gain in cash. Then you have to pay the stock. Now tax authorities register it very well because each broker informs them. And if you have an experience in the trading of the stocks, you already came across it. You will see that there are tax reports that your broker prepare for you where every transaction is registered, and one of the main reasons why they collect it in order to inform the tax authorities and calculate your capital gains well, so you pay the tax as well. Mostly, in most of the countries, the corporate income is taxed 2 times. Why it taxed 2 times? So first, firm has some income, then it pays tax on its income. After that, this income is distributed, or can be distributed, or part of this income can be distributed to the shareholders, and then those shareholders themselves would pay tax again. So this income is paid first on the corporate level, then it is also taxed on the personal level of the shareholder. But in some countries, for example, Australia, it might be done in another way. This is called imputed tax system. Under this system, there is a single rate that would be paid from the income, and regardless of whether it is the corporate level or personal level, if you overpay on one level, you will receive it back. If you underpay, you will have to pay. So there is a, let's consider how it works. Let's say that the the tax rate is 15%. There is a corporate level, and corporation paid tax as a 30%. So corporation will pay 30%. The 70 units is left to be spread as a dividend. Then on the personal level, what would be the change here? On the personal level, would estimate the tax not from what is left of after tax income, but we estimate it from the total operating income. And we know that the income tax is 15, but corporation already paid 30. And as a result, the shareholder, instead of paying taxes, the shareholder receives back 15, and the total cash that goes to the shareholder will be equal to 85. Yeah, so the idea is that all the payments of all the tax payments are balanced in order to make sure that investor receive corporate income minus 15%. If corporation taxes are higher, then investors would receive some money back. If corporate tax is the same as the tax on the dividend for the investors, then it would receive 17. So in this case, investor will not pay anything. So here is a 30 that is already paid. Then investor doesn't have to pay anything, and they just receive their dividend. The final case here, if you as a investor has to pay more than 30%, let's say you have to pay 47%, then you would has to pay additionally. The firm already paid 30, and you as a private investor has to pay 70 on top of that. So effectively you will receive 53 out of 100. So you can see here that investor receives income minus tax, regardless of the tax on the corporate level. All those taxes will be compensated on the personal level, so you will either receive some money back, pay nothing, or has to pay additionally to have as much money as you should, which is income that corporation made minus taxes. And this system is called imputed tax system. Also, making decision of the paying out money, so making payout decision, building payout policy, we should consider some additional factors, which is the life cycle of the firm. On the different time periods, firm does different payout policies. So if the firm is very young and expanding, it is less likely to pay out money as a dividend. If the firm is more mature, has less growth potential, but generates stable cash, it is usually recommended for such firm to pay money as a dividend. Also, firm doesn't have to pay out everything that it has. It might need some cash to secure its stability, and this is also the factor that should be considered. There are firms that never pay dividends, like Google, or there are Amazon, many other, and still they grow quite well. Recently, we had, during this COVID, we have some downfall on the market as a whole, but still, if we look at the longer trend, the stock prices, they go up, including the Google. And now we go further to another aspect of the corporate financing. Now we will talk about the borrowing, whether firm should borrow, how much it should borrow, whether it is in the interest of the shareholders or it's irrelevant. And here again, this Modigliani Miller, they also claim that they may, again, here, like they did with the payout decision, here they also claim that it is irrelevant whether firm borrows or not borrow. Any structure of financing leads to the same results according to their points. And again, we will consider example to illustrate this idea. There are some assumptions here that this theorem is based on. First, that we should omit the taxes. Think that, assume for the sake of the illustration that there are no taxes. Also, we should assume that the capital markets work well and that the individuals and firms has the opportunity to borrow money and the same conditions, so having the same interest rate, having the same term structure of borrowing, and in that case the financing structure of the firm is getting irrelevant. Yes, so this is something we discussed now. Capital structure does not affect the cash flows. If there is, we reduced market frequencies, we emit taxes, and there are no additional incentives for the managers in terms of the capital structure. So they are not interested. No, they are indifferent for that. Here is an example. We have a leveraged firm, the first one. So this unleveraged firm, excuse me. So all its business is financed through its own capital, and purchasing 1% of the stocks of such firm, we have 1% of the value of unleveraged firm, and returns would be 1% of the profits that firm has, which is, those are returns that we as investors are eligible to. If the firm is leveraged, so here we have L for leveraged and U for unleveraged, then we purchase 1% in debt, 1% in equity of the firm, and effectively we also have 1% in the total value of the firm. Here we have on the debt, we have 1% of the interest, and as the owner of the equity, we have 1% of the profit minus interest, but as we own debt as well, interest is something we receive as investors, and the returns are also the same as we had in unleveraged firm. If we decide to, if the firm decide as alternatively what we can do. So this was the first condition, and alternatively what we as investors can do, we can borrow money ourselves and invest those money in the firm and have the profit of that high. And this would be the same as the case, then the firm would borrow money, yes, so, and pays interest itself. So in this case, we considered a firm that doesn't borrow money, unleveraged firm, and firm that would borrow money, and the results are the same. And here we consider firm that borrows money, and we compare it with the case then we as a private individual borrow money and invest those money in the firm, and also they claim that that the effective outcome would be the same, of course considering all those assumptions that this model is based on. Here we have another example that we will work with to illustrate some other points on the debt policy importance. What they claim here is Modigliani Miller. What is they claim? That firm, it is irrelevant for investor whether the firm borrows money or not, because investor can replicate the same result by borrowing money themselves and invest into the firm. And this is how they would illustrate it. So here first we have a firm that is unleveraged. So we have some shares, price per share, market value of share, and there are different potential results, potential outcomes might be different, and we have some that we would expect, the most likely. So like we did in scenario analysis. Then what firm can do? Firm consider changing its capital structure and borrow money. So we choose borrow money and do stock repurchase. Before that, look, firm has no debt and price per share was 100. Now firm has debt, but it repurchased half of its shares, so the market price per share remains, but the total number of shares get two times lower, and firm has debt of 5,000. And result of this is that the return of shares went up from 15% to 20%. And this makes sense because now we we increase the leverage, so we have less capital by ourselves, and every dollar invested in this capital leads to the higher return. But as a result, also if we have losses, we also suffer more. So the result is more sensitive to the changes. You see, so if the things go better than we expected, then instead of 20%, we would have 30%. But if the things go worse than we expect, so in the first scenario, even if earnings are quite low, we still have positive return on shares. But if we get more leveraged, then in this case, we have a return of shares equals to 0. And what we can do, we can graphically present different different financing structure. If we have everything invested in equity, our operating income is flatter. So earnings per share and operating income, we are more likely to have them positive. And if we have some leverage, so in this case we have 50% of leverage, then we are more likely to have higher returns if the things go good, but also we are more likely to have 0 earnings per share if things go bad. And the argument that they make, that is for investors, it is irrelevant whether firm borrows money or not borrows, because investor can borrow money itself. So we can buy the same amount of shares, and we have some amount of money. We can borrow the same amount and invest this doubled amount, and having the same return of investment of 20%. And so as investors can replicate the same financing structure, for the firm it is not necessary to take additional risk by borrowing money. And here those arguments and those theory is put together. So if the markets work fine and the conditions on the personal level and on the corporate level of borrowing, they are same, then the value of the firm is not affected by the capital structure. And like the analogy from the book that they use is that we can assemble everything ourselves, so it's not cost more to assemble a chicken than to buy the whole one. So we can, if we as a private investor can replicate the same financing structure, and the firm doesn't have to think here in this regard, because anyway investor can adjust the level of risk with the personal financing vehicles. If we continue this example, so we have a earnings per share, some price per share is given, and expected return. So if there is all equity, expected return is 15%. If we borrow something, expected return is, if we borrow half money is debt, half money is equity, then the expected return is 20%. And out of this formula, we can estimate the return on asset. This is the basic formula of return on asset, where we would multiply the fraction of the debt and fraction of the equity on the return on debt and return on equity, and this would be the total return on asset. This formula should be familiar to you. This is very similar to the one we talked about working with the weighted average cost of capital. Just here we omitted the taxes, because this is one of the conditions of the model. And this formula, we can transfer it, because quite often we are more interested on return on equity. So if return on equity, it means return that we receive by purchasing the shares of the firm, and we can convert this formula to this level that will have return on assets, where we estimate return on equity from return on assets, return on debt, and fraction of those two. Out of this formula, we can see that the more we borrow, the higher return on equity gets. But as there is also return, the more we borrow, the more sensitive return on equity becomes. And if things are good, they are very good, and if things are bad, they get very bad. So the amplitude of changes is stronger. The more we borrow, the more amplitude of changes. For the unlevered firm, going back to those examples, we have the return of 15%. And expected, it is something I just mentioned. From this formula, we can see that expected return on the stock, of the leverage stock, increased proportionally with the increase of debt. But what we should keep in mind, something that we discussed with you so far already, that the same thing can be replicated with the personal financing tools. And we already estimated this on the table form. Now we use this formula to the same example, and we see that expected return is 20% as well. And this is something that I just mentioned. So the amplitude of changes is way stronger. So we have different scenarios that we started from. The basic one was 1,500. If it goes down to 500, the change in all equity firm is only 10%. The change in 50% debt firm is 20%. And if we borrow more, the magnitude of changes would go even higher. If we try to draw the balance sheet of such firm, so we can make the fraction different. We can have a debt of 70%, equity of 30%, and in that case, the return on asset will be slightly different. If the cost of, also the factor that we should consider here is the cost of debt. The higher the cost of debt, so look here we have a return on the cost of debt of 7.5 and return on equity is 15%. With the same formula that we just considered with you, if return on debt goes up, the return on equity goes up as well, as the firm has to pay more money as a dividend, as interest rate. And the higher this gets, the higher would be the return on equity. This is the formulas that we came across already, talking about the weighted average cost of capital with you. And now we can again refer to them, talking about the sensitivity of the return to the changes in assets and in debt of the firm. Weighted average cost of capital, now we can see that it is also relevant for the return of assets. So the return of asset would be close or equal to the something that we have a return on assets, and this is what we should consider making the decision on the investment. Under Modigliani-Miller proposition, we have some return on asset, and this is built as a sum of the return of debt and return on equity, and those returns out of the formulas that we just discussed, we see that they would adjust accordingly, keeping the level of the return of the expected return on asset constant. Yes, so one goes up, another goes up as well, and as they are balanced through the formula of the weighted average cost of capital, the expected return would be constant regardless of the structure of the financing. Traditional view, something that we discussed, was something that something that's everyday, that is more relevant to the everyday understanding of the matter, is that there is some optimal structure, so where we can minimize the cost of equity, cost of capital, if we find the optimal combination of the debt and equity. There is some minimal point here that that we try to achieve. And the complete formula that we should work with includes the taxes. And let's use the example to illustrate how taxes would affect our calculation. The firm has a tax rate of 35%. The cost of equity is given, cost of debt. Let's estimate the tax-adjusted weighted average cost of capital. The debt ratio and equity ratio are given. Everything else is given on the previous slide. Using that, we can estimate the weighted average cost of capital by putting the numbers in the formula. And if we introduce taxes in our model, then there would be some difference between the opportunity cost of capital weighted average cost of capital. That weighted average cost of capital is slightly different due to the taxation, but still it is quite stable, and under the Modigliani-Miller assumption it would be also irrelevant how we put the debt and equity in our financing structure. Yeah, here it is. So we have some time for the questions. If you have any, please let me know.
Actually, I have a question not about this material. I have a question about the second homework. I saw that in the Smart LMS there are new guidelines. So does it mean that we can start do it? Or...
Yes, you're very welcome to start doing it. I told you in the beginning you should start doing it because it might take time.
Okay, so thank you.
Yeah, the deadline is, even though it's till 27th, but it might take some time because there are multiple exercises. And please start working on it. Anything else? Good, then thank you for being here today and see you next week.
Thank you. Goodbye.
Thank you. Goodbye.
Thank you.
Goodbye.
Bye. Bye.